TheoTrade. This is Don Kaufman, October 23rd, 2021, doing the TheoTrade weekend update on a Saturday morning. Good earnings, going bad. We're going to discuss that and much more here, of course, on this weekend's update. Also, a highly detailed discussion regarding an absolutely just massive volatility contango. We'll even look at a couple of different ways to be able to trade in the midst of such kind of a wild volatility contango. And for those of you that are a little newer here, well, what a volatility contango really means. Let's start with, albeit brief, market week in review. And of course, I think the place to start is the rally. Persistent. It goes on. And something we do very consistently here at TheoTrade is we kind of detail some of the weekly action as it pertains to expected moves. It's a very quantitative kind of metric and a quantitative way to take a look at some of the price action on the week. And I'll explain that in a bit more depth, right now. So here we are inside of the SPX. Now, the SPX I've always named kind of the mother of all products because, quite frankly, the SPX people, this is really what moves markets. You could talk about buying and selling stock until your heart's content, but when you start looking at the SPX and the sheer magnitude of size now moving through here, and by the way, what I'm highlighting on your screen, the SPX did 1.7 million contracts. And here's the interesting irony. It traded pretty much in line with what it's done in the previous 5 trading sessions. So the entire market traded just around 43 million option contracts, though the SPX did 1.7 million itself. Take a quick glance over at the spiders, and the reason I'm looking at the spiders because in effect they're almost identical to the SPX, right? 6 million contracts trade there. Before you know it, you start to look at something like VIX contracts, which you take a detailed look at this in a few minutes. They're good for another 300,000 plus. But anyway, you start adding this up and you realize like the entire marketplace is just S&P centric. And that's really when I say it drives the marketplace. You have billions of dollars every single day flying through the SPX, the Spider, the VIX. And it is in effect all the exact same product. But the hedge for those products, of course, is these S&P futures, which again makes the SPX the most pivotal marketplace, in markets. So with that, this last week of trade, the SPX was looking for a move of plus or minus approximately $61. Okay, we actually edged very, very slightly outside of the expected move. In fact, anytime, at the end of a trading week that we are outside of what the option markets depicted risk to be, of course, we would highlight that. And this week, we do have a very, very mild breach. And, the reason I keep stating it's such a mild breach is, the SPX, all right, it ceases to exist and it closes right at the bell. But if you looked at the S&P futures after the bell, they actually dipped back down. And, if the SPX had still been open, it would have actually pulled the SPX directly back to the 45.33. So do I count this as a breach? Technically, yes. But again, the futures contracts tell a little bit of a different story. They did sell off a bit, again, after the market closed, pulling, the effective pricing right back in line with the expected move. Nevertheless, so the SPX continues its rally to the upside. Volatility continues to fall to a degree. In terms of the QQQ, here we actually apply auto expected moves. One of the things that we're going to talk about here momentarily is a rough start to some of the tech earnings. However, when you start looking at the QQQ, all right, which is, of course, the Nasdaq, you don't see much of a rough start here, do you? I mean, in effect, all right, it had a blistering move to the upside on Monday. The risk, and again, the remainder of the week, we just edged to the side of the expected move. And when I bring these expected moves, into the equation, and I said they're very, very quantitative, you have to kind of recognize, well, why is he bringing up the expected move? Look at the marketplace throughout the course of this week. The entire trading week, and I mentioned this even on Wednesday, in terms of the SPX, the entire trading week came down to the edges of this expected move, whether it was the SPX, of course, the QQQ, and apply the auto expected moves. Okay, you can even take a quick glance over at the IWM, which just came just shy of the expected move, but again, not nearly the move inside of the Russell that we saw in the other major indices. And that's a great place, again, for kind of a quantitative look. Did the market do what it was anticipated to do, based on option premiums? And the reason I spend so much time on this is we spend times in technical analysis and RSI and MACDs and Fibonacci's, but this is an actual marketplace, meaning that the options marketplace is already handicapping risk to the forward week. You should probably pay attention to that because literally, well, specifically when it comes to the SPX, there are billions and billions of dollars, all right, traded around, again, the edges of these expected moves, which make it, again, the most pivotal, tool in the marketplace today that we know of. With that, so you just got to feel, all right, it's a blistering rally in the S&Ps. The S&Ps actually outperform the QQQ. The S&Ps outperform the IWM. The IWM is the kind of laggard. Then we're going to cruise over to the financials. And the reason I want to cruise to the financials, and I'll bring these up again momentarily, is they definitively were outside the edge of the expected move. Okay, along, of course, with the energy sector, continued a degree of a rally, but again, much deflated versus some of the previous weeks. The energy sector was mildly higher this week. All right, so let's get down to business. We just covered a couple of the kind of the critical sectors in the marketplace. The bottom line of this week, and what it really came down to, is the latter portion of the week, it really had a rather rough start when it came to tech earnings. And it really kind of bifurcated the entire technology sector. First, if we look at our monsters of tech, now monsters of tech, it's Apple, Amazon, Facebook, Google, okay, Microsoft, compiled into one, okay, index product. And this is something we built ourselves here. So it's compiled into one index product. It got tagged and did just massive volume. But, overall, you just didn't feel it inside of the marketplace, meaning that, tech got tagged, but even, okay, the monsters of tech themselves feel a little bit, as I said, bifurcated. Apple, absolutely just nothing. I mean, yeah, the S&Ps were off mildly, but the Nasdaq took a bit of a hit. Apple, as I said, absolutely nothing. And I think a lot of the tech earnings and the rough start to tech earnings could be blamed expressly on Apple, simply their limitations in the new iOS in terms of advertising, which we'll go ahead and we'll bring up Snap for a second. Listen, Snap is not going to be a pivotal underlying that's going to be a market mover, okay? However, their earnings were so diminished specifically because of Apple that this is where the market not only took notice, but obviously the Snap earnings announcement kind of systematically dismantled. Well, Facebook, big drop here of about 5%. Google, which is, of course, ad revenue based, drop about 3%. Amazon, it's worth noting at this point in time, is pretty much flat on the year, up about 4%. It's actually one of the underperformers out there. So again, a rough start to some of the tech earnings. But as I said, the Snap ad revenue drags down big tech. It's also, of course, worth bringing up none other than Intel. Intel subsequently also had a rough start to some of the earnings. Twitter being brought down, of course, by Snap revenue in here. And, we could go on. But at this point in time, seeing just a glimpse of one or two negative earnings does not necessarily make a market, dire in terms of tech, because while this was going on, again, we saw big tech getting hit fairly hard. And again, I would keep good eyes on Google, because Google is still up roughly 60% on a year-to-date basis. This is unequivocally one of the most pivotal stocks in the entire marketplace. Also, of course, has earnings. But before I go any further, and it's good earnings going bad. Well, they're going bad. But this is not going to help us really handicap, all right, what some of the earnings are going to be. And I want to elaborate upon this for a moment, because what has happened is the moment that Snap's earnings came out, markets are really good, all right, at kind of repricing things immediately. And one of the things it did, if you look at Facebook, all right, Snap earnings took Facebook apart to the tune of 5% instantaneously, all right? It repriced Google, again, instantaneously. So in effect, when you come into the Google earnings, when you come into things like Facebook earnings, or even Microsoft to be up to the bat, up to the plate, I should say, this week, these are likely already pricing in some of the effects, okay, at least that we know of at this point, of ad revenue, specifically related to, of course, Apple changing the iOS. All right, so I want to push that aside. Nevertheless, at the same time, you got to recognize that we are in an incredibly low volatility environment, which I'm going to be talking about here momentarily. We're in a low implied volatility environment, yet there are some pretty strong warning signs specifically related to tech. So why are we seeing such low volatility at a time where tech is almost like, whoa, man, this could get a little bit out of control here? We just saw, again, a 5% sell-off inside of Facebook, okay? On any other day would be just, top line kind of news. But most of the trade action that happened in tech was largely masked by the strength specifically inside of the financials. Financials continued to the upside. Energy actually helped it. And again, we move forward. It's why the S&Ps, the S&Ps are kind of caught in the middle over here with tech selling off a little bit. You've got financials rallying, energy's rallying, and the S&Ps, they finished largely unchanged. And again, this is something that we had not seen for the last couple of months, where this marketplace gets once again extraordinarily bifurcated. In fact, you kind of feel the bifurcation inside of the advanced decline line. It's not too often you're going to see this, but the advanced decline line in the S&P 100 on Friday, it actually closed higher, with the S&Ps lower and the Nasdaq considerably lower. And again, that's exactly this bifurcation that I'm talking about, not only within the market as a whole, but also within tech, where you're even seeing stocks like Tesla, breaking to the upside. Even NVIDIA had kind of a wild trading session. Can't be overstated here, where NVIDIA actually peaked into all-time highs before reversing. We saw those kind of reversals in a number of different products. So moving forward, okay, throughout the course of this week, what I am going to do, and what I have been doing, is buying quite a bit of volatility. Not because I think volatility necessarily has to spike, but I think at this point, with seeing some of the activity on your screen, and again, the monsters of tech are a little bit threatened right now, I think it's a decent time. If you don't have long volatility, you need to, stock up on some long vol. Monday, Tuesday might be the last opportunities we get to do that for some time, just depending upon what the earnings are going to be. Now, in no way, shape, or form, again, am I alluding to some of the spectacular earnings, of the, previous portion of this year. I'm not going to allude to those are going to go horrifically wrong, but there are inflationary signs everywhere. I think we realize that. There's one other stock worth a quick discussion, and this one kind of caught me off guard, and it's actually Beyond Meat, because they warned, again, their earnings are only right around the corner, but their warning was substantial. And this is where, again, I am going to give you a little bit of a feel. There could be a lot, not of just earnings coming out this week, but some warnings. And I would look specifically to retail. If retail stocks start to warn, again, some of the inflationary pressures are taking their toll. All right. The other aspect worth noting here, and again, I brought up Beyond Meat because they warned, and it was a fairly shocking move to the downside in here. And again, it was right before their earnings. The other aspect worth noting here is that bonds, okay, which I've talked about just incessantly in the last couple of weeks, it almost feels like they got taken out of the equation this week. Take a look over at the TNX, all right? Interest rates, people, they're still exploding to the upside. So at what point will the marketplace, okay, be less accepting of rates exploding? I mean, listen, put it at 1.765. I mean, that's been some of the recent highs, and you got to go back, of course, to the March time frame for that. But getting up to 1.8% on the 10-year, unequivocally, I mean, those risks, those fears will come back to life. But at this point, again, markets do this. They just all of a sudden, they're like, you know what? Rates are going higher. And then they become accepting to a degree of higher rates until, of course, they continue to vault a little bit higher than that. Now, we are going to see quite a bit of economic news hitting the tape throughout the course of this week. If you are so inclined to look at the calendar, of course, you got GDP flash coming out. You've got everything from durable goods orders. There's even some new home sales thrown in there. Case-Shiller. It's a party, people, but there's enough economic news that you could see rates continue this kind of blistering move to the upside. One other thought on that particular front, of course, would be to look at the dollar. The dollar, which backed off in the midst of some of the big rally that we've seen in the last couple of weeks. The dollar also, if it does turn tail and start heading back up, could be a sign of more risk coming to us. All right. With that, again, right now, markets sitting back, okay, at or near highs. Tech earnings had a rough start. One of the things, again, that's being missed, I think, by most traders is that there's just this massive volatility contango. And when we start looking at the VIX is a 30-day, okay, look at volatility, but it really, people, I'm telling you, it just does not tell the story of what, in effect, is going on in terms of volatility, where the VIX is all the way back down to the 15 handle. Everybody's like, okay, volatility has subsided. Except it hasn't. Go take a look at the volatility futures. Take a look at the volatility futures themselves. Now, volatility futures exist for like November, December, and different months, of course, bring different risks. So one of the things that you realize about the volatility futures is just 25 days out. Just 25 days out, you realize the volatility futures are at 19. You're like, wait, what? Okay, yeah, so the volatility futures are at 19, but the VIX is actually where? At 15. The differential between 1920 and a VIX that's sitting at 15, okay, 43. See, eventually, these two products converge upon one another. And that's one of the things that, again, a lot of people don't realize when I say, what do you mean they converge upon one another? Well, let me display that a little bit. Sooner or later, this 1920 has to come down to whatever the VIX is, or the VIX has to come up to the 1920. There is a massive differential between those, to the point of, you start to recognize this, okay, there must be just a ton of short duration premium sellers, but at the exact same time, these volatility futures, they tell a dramatically different story. The volatility futures, you got to ask yourself, why are they up there? And then even crazier than that, you start looking at the volatility futures, which are at 1920. And again, I just wanted to highlight that for a second. You look at those things, they're at 1920. All right. But the next series out, okay, is at 2120, and then it jumps to 2280. And again, to look at this kind of graphed out a little bit, you can actually cruise over to charts on thinkorswim and then go to product depth. This is actually a tool I helped build and design on the thinkorswim platform. But what you're actually looking at is what they term a volatility depth chart. And what a depth chart shows you, it's November versus December versus January. But it's wild out there. It's just downright wild. Like, I've seen a lot of huge, contango in my time. What the marketplace is saying, and this is all that really matters. What the marketplace that was saying here, front month volatility is like non-existent. We're okay to go in the near term. There's like no risk. Everybody's warm and fuzzy. Back here, it's huge by huge. Okay, one of the reasons, of course, everybody's going to mention like, oh, it's the debt ceiling, it's this, it's that. And you would be right to say that. Like, it's fine. You can come up with 50 different reasons why the volatility is so substantial in the back month, but right here in the near term is actually negligible. Whatever it comes down to, okay, if you're afforded the ability to buy some volatility, you should probably do it because the marketplace is telling you that the back month is going to get volatile. Some of the trades that I'm actually doing in here, and I've been talking about this trade quite a bit, I'm actually using what's termed a VIX volatility spread. So I'm actually selling like a $4 wide put spread to turn around and buy like a $10 wide call spread, and I'm doing it for anywhere from 0 to a credit. And this is something, you know, I've been executing these for the last couple of days. You can see a 0.00000 fills, 3-cent credit, 5-cent credit. So I've been executing this particular trade for the last couple of days, loading up on a couple of contracts, getting myself net long volatility. But I'm getting long volatility 60 days out. And when you start looking at the contango, like, the VIX options are not priced off of the VIX. Like, the VIX options are actually priced from the volatility futures, which is a crazy thought to most people. So we're not really trading like, you know, oh, it's low volatility, but I'm in the December expiration. In the December expiration, they're already pricing the December expiration volatility up here near like, you know, 21 and change. So have a little respect. Like, volatility is smart. It knows, okay? It knows like, hey, volatility is very likely to go up in the back month. Again, you got to consider this because especially at a time like that where the VIX actually collapses back down, you may not be afforded, okay, another opportunity to get long volatility for Dece or Jan. And as I said, there's 50 different reasons that everybody, of course, is going to price volatility higher in those back months. But there's only one thing to do about it, and that is turn around and buy some volatility. But the exact same time I'm buying volatility, okay, the same time I'm buying volatility, I am actually selling back month premium. And I'm selling back month premium because you go out to like January options, they're still trading 20% implied volatility. In fact, it gets even better than that. Like skew, even in the midst of all this, skew ain't half bad. Like, look at some of these way out of the money options in the S&Ps. You're trading like 32, 34, 35 volatility. Okay, it's gold, Jerry, gold. So think about it. With one hand, I'm afforded to be able to get long volatility. With the other hand, I'm actually what? I'm out there selling it. Okay, there's some nice little arbitrages available for even the retail trader in such a wild, again, just a wild volatility contango. Last but definitely not least, okay, one of the aspects that I really want to resonate with you, cruise back over to the charts here in the SPX, volatility in the near term continues to get crushed down. So in the previous week of trade, we had about a $61 expected move. This next week, we're looking at a $54 expected move. So we move bigger than expected, and yet they contract volatility, which once again, I want this to really, okay, stick with you. Do not sell short duration premium, okay? It's insane right now low. The volatility in the near term, okay, that is something that I am a buyer of. Like, what are you going to sell 10% implied volatility? Okay, are you going to sell 9% IV? Of course not. The marketplace in the near term, okay, all right, and on day-to-day basis has actually exceeded expectations, meaning that, you know, if the marketplace was supposed to move $20 in a day, it's moving $25, it's moving $30 in the day. Okay, mark my words, don't sell short duration premium. You're going to sell some premium, you got to go out to the back month. The other aspect, look to get long volatility when you can get long volatility. With that, hey, you know what? We're going to be sitting pins and needles throughout the course of this week. Not only do we have some economic news, again, we've seen some really good earnings kind of going bad. I would expect a fairly tumultuous week, some more volatility possibly coming back into the markets. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.